Welcome to the Deep Dive. Today we're taking a granular look at the story unfolding at Quanex Building Products Corporation, or NX. And this is really a story of a major operational comeback. For anyone following this company, you know the context. Going into this report, the stock had just plummeted over 40% in the last year. This was truly a moment of high pressure.
It was more than high pressure. This was a prove-it quarter in the extreme. I mean, they had that prior earnings per share miss, and market sentiment was just deeply, deeply negative.
Right.
Yet when the Q4 numbers for fiscal 25 hit, the market reaction was immediate and, overwhelmingly enthusiastic.
And what does that tell you?
It tells you something crucial. Investors saw an execution story, something company-specific that seems to be overriding the broad sector weakness we're seeing. I mean, remember, the housing ETF, XHB, has struggled. So this success, it feels homegrown.
That sets our mission perfectly. We need to unpack these Q4 results and really dissect the drivers behind this sudden wave of optimism. What levers did management actually pull to generate such strong performance, especially when the overall housing market is still so challenging?
Let's start with the hard numbers, because the scale of the beat is really what grabbed everyone's attention. Adjusted diluted EPS came in at 83 cents.
Wow.
And this wasn't just a beat, it was a knockout. Consensus expectations were only 50 cents.
So they outperformed by what, 33 cents?
33 cents. That's a 66% surprise upside. And on top of that, GAAP EPS flipped to a positive 43 cents a share, which reverses a loss of 30 cents from the same quarter last year. It's a fundamental shift in profitability.
That profitability beat is enormous. Usually when we see an EPS margin that wide, we expect a corresponding blowout on the top line. Did revenue follow suit?
Not quite a blowout, no, but they were solid. Net sales were $489.8 million.
Okay, so it edged out consensus.
It did, though it was slightly down year over year, about 0.5%. The real strength, though, it wasn't in sheer volume. It was in efficiency and margin control.
Which you can see in the gross margin.
Exactly. Gross margin jumped to 28.1%, which is up significantly from 23.8% last year. Adjusted EBITDA hit $70.9 million, giving them a very healthy 14.5% margin. That's just impressive cost discipline.
And this leads us to the metric that truly defines a turnaround story: cash flow. What did that profitability translate to?
This is the highlight. The cash flow story is, I'd argue, the single greatest driver of the positive sentiment. Free cash flow, or FCF, surged to $66.6 million for the quarter.
And you have to pause there, because last year FCF was negative, wasn't it?
It was negative $8.2 million. So to swing nearly $75 million in cash generation year over year in a single quarter, that demonstrates a massive improvement in operational discipline.
That's the dry powder they need.
It is. This cash pivot gives them flexibility. It gives them options.
Okay, let's unpack the core operational catalyst that allowed this to happen. Because the narrative really boils down to fixing one major self-inflicted wound: the window and door hardware facility in Monterrey, Mexico. This issue has been a drag on the financials for a while now.
You're right, it was the central bottleneck. To be clear, this wasn't just a minor inefficiency. The issue was complex, a lot of supply chain and logistics tangles that led to huge production backlogs.
So they couldn't get components out the door reliably.
Exactly. And this forced management into some highly aggressive and expensive measures. They actually quantified the negative impact on adjusted EBITDA from this in Q4 at precisely $8 million.
And management specifically noted that the cost of the fix was actually higher than they first expected. Why did it balloon like that?
Because they chose speed over thrift. They moved to 247 operations, which instantly increased premium labor costs and critically forced them to rely heavily on expedited freight.
So expensive air shipping, that kind of thing.
Right. Just to get components out the door and reduce that backlog, they knowingly traded a temporary jump in cost for the long-term benefit of stabilizing the operation.
So they absorbed an $8 million hit in Q4 to get ahead of the problem. What's the forward outlook on this headache?
Well, the good news is that management says they're slightly ahead of schedule. They now expect to return to what they call normal operating conditions early in calendar year 2026.
Okay, but that $8 million problem doesn't just vanish overnight.
No, it doesn't. They caution that the forward drag, the negative EBITDA impact for Q1 of fiscal 26 is still expected to be about $3 million.
But the key piece of analysis here for you, the listener, is that they anticipate that $3 million drag goes to zero beyond Q1.
And if you do the math.
Right. If we combine the Q4 hit of $8 million and the expected Q1 drag of $3 million, that gives the company an annualized run rate EBITDA recovery of roughly $11 million.
And that is a powerful, company-specific self-help story. It is a source of profit improvement that is entirely independent of whether or not the Federal Reserve cuts interest rates.
That $11 million figure is essential. It's execution capital they generated internally.
It is. Solving this internal problem gives them a clear, definable path to profit expansion that their competitors, who are just waiting for a sector recovery, may not have.
Speaking of capital, that massive cash generation means their balance sheet now has some real muscle. What did they do with the cash?
Debt reduction. It's the primary strategic focus. Management repaid $75 million in bank debt over the course of fiscal 25.
That's responsible management, de-risking the enterprise.
Immediately. Right now, their net leverage ratio, that's net debt to last 12 months adjusted EBITDA, is sitting at 2.6 times.
Okay, let's break that down. 2.6 times sounds manageable, especially now, but I remember management emphasizing some investor pressure. What's the target?
You hit on a crucial point. While 2.6x is okay, they noted strong investor sentiment demanding leverage below 2 times, and that aggressive demand is absolutely driving their focus. So debt paydown is number one, but they did confirm they'll do opportunistic share repurchases, especially since they view the stock as, quote, very cheap.
Beyond the finances, they also updated on the integration strategy and the resegmentation of the business. That's usually where we find hidden efficiency gains.
Absolutely. The business has been resegmented to align with a long-term profitable growth strategy, and management says they're already seeing positive takeaways, particularly operational improvements from sharing best practices in the new Extruded Solutions group.
And this must be where they found the justification to raise the synergy target. I mean, raising expected total cost synergies from the original $30 million, which they've already hit, all the way up to $45 million is fantastic.
It signals profound confidence. It means the initial estimates were conservative and the structural overlap is greater than they first thought.
So deeper, more durable cost overlaps.
Primarily in procurement and consolidating supply chains, yes. Hitting the original target and then raising the ceiling by 50% means the integration risk is dropping and the execution upside is rising.
Okay, so what's the near-term expectation for these synergies in fiscal 26?
Management anticipates capturing an additional $5 to $10 million in synergies just in fiscal 26.
And that range depends on volume.
It does. The range is dependent on overall volume performance naturally. But think about that. That $5 to $10 million is pure structural upside being added to the bottom line, regardless of how tough the housing market gets.
Now we pivot to the future. And this is where that internal success meets the external friction. Despite all this, the broader environment remains sticky. What did management say about their official guidance?
The macro view is unchanged. Persistent headwinds. We're talking affordability challenges, high interest rates, and just generally cautious consumers. Management explicitly believes 2026 will be a generally flattish demand environment overall.
Hold on. If they just pulled off an execution miracle like that $11 million annualized recovery, why is the formal guidance still flat? Are they heavily sandbagging? Or are the macro headwinds so brutal that even an $11 million fix gets swallowed whole?
It's a bit of both, but primarily caution. They explicitly withheld formal guidance for fiscal 26 due to limited transparency and market uncertainty.
Which is pretty common right now.
Very. They plan to revisit it when Q1 earnings are reported in March. Their informal view, though, is that fiscal 26 revenue and adjusted EBITDA will be flat compared to 25.
But they did give a cadence to that, right? First half weaker than the second.
Correct. They were quick to caution that the first half of 2026 will likely be more challenged than the first half of 2025, which implies a required but still tentative, somewhat improved second half.
That caution is reinforced by the seasonality of this business. Q1 is always the weakest. What specifics did they give for the upcoming Q1?
Q1 is seasonally very weak, and the numbers reflect that. They expect consolidated revenue to be down a steep 16 to 18% quarter over quarter.
And the margin hit from that?
Significant. The adjusted EBITDA margin is expected to decline by 800 to 825 basis points quarter over quarter. When volume falls that sharply, the hit to margin is just unavoidable.
Let's talk about the SG&A line too, because that modeling assumption looked a little high for Q1.
It did. They are baking in an SG&A assumption of $73 million for Q1, which is higher than the prior year. They chalked it up to three things: accruing bonuses at target, unlike last year, general inflation, and standard merit increases.
So higher SG&A, lower seasonal volume, plus that remaining $3 million Monterrey drag.
Yeah,
It sets the stage for a weak but fully expected Q1.
exactly.
Okay, let's shift to industry dynamics. When the market is flat, competitors often get aggressive on price. Are they seeing irrational pricing out there?
This is an important question, and management was emphatic that they are not. What's fascinating and what gives them an edge is that their customers balance pure price against supply chain reliability.
So having stable supply is a competitive advantage.
It is. Having reliable components offsets pure price moves. They maintain their pricing approach as rational, just passing through true costs, not engaging in predatory pricing. The reliability story post-Monterrey fix is a major asset.
And what about long-term opportunities? Anything structural?
Well, the long-term fundamentals for housing are still positive, demographics, household formation. But specifically, they noted potential upside in their custom solutions group, which deals in wood components.
How so?
Their theory is that if the current higher tariffs on certain imported materials stick, it could incentivize demand to be insourced back into the U.S. to mitigate that risk, creating a structural demand shift for them.
Interesting. And finally, the recovery path. Repair and remodel versus new construction.
Yeah.
What leads the way?
They strongly expect R&R will lead any housing recovery. Their products are more weighted there. New construction is more complex for them because its impact is sensitive to the build mix.
Right, smaller starter homes versus large single-family homes.
Exactly. The size of the house directly dictates the number of window and door openings, which is critical to their volume. So they need not just more new construction, but the right kind of new construction.
That's a thorough synthesis of a highly complex quarter.
Mm.
Now we move to our segment. This is not financial advice.
Right.
The market reacted strongly today. So what's the outrageous but plausible trade idea here?
We're pitching this as a bet on internal execution versus external macro uncertainty. The market, I think, is fundamentally underappreciating the compounding effect of the Monterrey fix and the synergy capture. We established that the operational issues alone translate to an annualized run rate EBITDA recovery of roughly $11 million, which, critically, is independent of any macro improvement. This is a clean, execution-driven gain.
That 11 million is the leverage point.
Exactly. The pitch is aggressive. Propose buying out-of-the-money call options expiring mid-calendar 2026.
So you're looking out over a year.
You are. The trade is predicated on management not only hitting that stabilization timeline in the first half of 26, but also being able to reinstate formal positive FY26 guidance during the Q1 earnings call. That's expected in March. It's a tight timeline.
The optionality here hinges entirely on that March earnings call. If they can formally guide up, the market will re-rate the stock immediately.
Precisely. The major upside leverage comes from that operational improvement, the $11 million fix, coinciding with the first credible signs of a macro bottom in the second half of 26.
Which is what management informally implied.
Exactly. The stock has already shed over 40%. If execution delivers and the stock can regain even half of those losses by summer, the deeply out-of-the-money option exposure should pay off big. We're betting that the internal $11 million EBITDA uplift provides the fuel for that re-rating.
So what does this all mean? The Q4 beat for Quanexs was primarily an execution and cash generation story, headlined by that spectacular $66.6 million free cash flow flip. Management provided a clear plan for stabilizing that $8 million operational issue and at the same time raised the bar on achievable synergies. They are taking internal control during external chaos.
My final thought for you, the listener, is to consider how quickly management can convert the remaining synergy target of up to $45 million. If they capture the higher end of that $5 to $10 million target in fiscal 26, combined with the stabilization of Monterrey, that combined execution could potentially deliver far more momentum than the market currently expects, powering the stock through what will be a challenging first half. Keep an eye on the March Q1 earnings call for that guidance.
That's a powerful note to end on. Thank you for joining us for the deep dive. Remember that this information is strictly for informational and analytical purposes and is not investment advice. We appreciate you trusting us to keep you informed.